Welcome back. It wasn't just Canada that reported a strong jobs report this morning. As well as that, in the U.S., the non-farm payrolls number, its jobs report, came in with the news that 261,000 jobs had been added to the U.S. economy during the month of October. That was roughly 70,000 more jobs than had been expected. And the September number, the month-old number, was revised upward to 315,000 jobs added in September, significantly more than the 263 that were initially announced. What does this mean to the path of the Fed and ultimately to investors? We're joined now by Ivana Delevska. She's founder and CEO of Spear Invest. Ivana, great to have you back. What does this mean to the U.S. Fed and ultimately to markets? A much stronger than expected employment report.
So thanks for having me, Paul. Investors were expecting a very strong jobs report. Post the Fed meeting last week, the Fed chair Powell was pretty hawkish. So basically referring to the strong labor data that we're seeing and the strong wage growth that we're seeing. So this just means that we're going to have to expect more rate hikes ahead, even though earnings are pointing to a very slowing economy.
How do you think this looks to the Fed? What do we see, for instance, in terms of wage growth to the Fed and its presumed effect on inflation?
Well, we believe that wage growth is going to be the biggest risk. It's the one with the most lag when you look at the inflation numbers. Many people are pointing to slowing commodity prices, slowing goods prices, but really wage growth and real estate prices are the two drivers that are really going to be driving the inflation numbers going forward. So we don't really see wage growth coming down anytime soon.
Okay, what do Spear Invest portfolios look like right now in this environment?
So we are positioned in two ways right now. We're trying to find companies where we see little earnings risk going into the next year, and we're also trying to pick out some cyclicals where we've already seen a big hit to earnings. So we really like on the end of low risk to earnings, we really like cybersecurity, and on the end of names that have been beaten up with earnings surprises to the downside, we like semiconductor stocks.
What do you think of the most recent earnings from the tech giants, the likes of Amazon, Microsoft, Google? It's been a very up and down quarter. Apple as well. What do you make of the earnings from those companies and what they're telling us about the broader macro environment?
So the earnings from all the tech giants except for Apple surprised significantly to the downside. And it wasn't even that the earnings reports were that bad, but people's expectations were pretty high going into them. We're seeing slowing in ad spending. That's been a trend that's been going on for a few quarters now. But what surprised to the downside was slightly slower growth in cloud spending, which many of the companies try to explain as their customers are trying to optimize and cut cost. This is not something that can go on forever. You can only optimize cost once. So we think this sets a good base for earnings going forward for the cloud vendors in particular.
What sectors of the U.S. stock market are you avoiding at this point?
So we're avoiding all cyclicals. We think that the earnings effect of interest rates is still to show up in numbers. We don't like housing, we don't like autos, we don't like anything basically that is interest rate dependent. And we do like areas where the valuation impact of the interest rates has already been priced in. So we think tech actually is going to form a floor a little earlier than the rest of the sectors. And tech giants usually collapse towards the end of a bear market. So it's almost like a good sign to rebase expectations for the sector.
Okay, let's talk about some of the stocks that fit the description of what you like in this market. You mentioned cybersecurity. Crowdstrike is one, ticker symbol CRWD.
Yeah, that's right, Paul. So we really like Crowdstrike. They are a leader in endpoint security, and over the past several quarters, they've built a portfolio of other related products. So they're expanding into this huge white space, which will allow them to grow at 30–40% plus rates going forward. And all of the cyber stocks have been hit post the tech giants' earnings that we talked about because people are worried about broader enterprise spend. But our channel checks indicate that cybersecurity spend will be the last one to get cut.
Palo Alto, perhaps a better-known name in the markets, PANW, another cybersecurity player.
That's right, Well, so Palo Alto Networks is kind of on the opposite side of the spectrum from CrowdStrike. They come from a background of a legacy vendor, and that is why they're more well-known. The company has been able to gather a portfolio of next-gen cybersecurity solutions that is now growing at 50–60%. So that's really aiding the growth of the overall company, and that's allowing the company to beat expectations pretty consistently every quarter.
Okay, and Nvidia, the graphic chip maker, in years past, a steady gainer in the stock market. It's now trading much down from its peak.
That's right. So Nvidia is back to being a top position for us. We really like the long-term story for Nvidia on the AI spend. We saw from even in an environment where people are cutting budgets, we saw earnings reports from Meta where the company said they're continuing to spend on AI. Similar news came out of Oracle. They're continuing to spend on AI. So we think all of this will bode well for Nvidia that has now been underperforming due to semiconductor related concerns. And just to back up and explain basically why is the stock down so much is semiconductor stocks are very sensitive to demand. They're first to go into the downturn, but moreover, inventory is exacerbating the issue. So while demand may be down in the teens, the numbers that they're seeing is more down in the 40s and 50%.